Hi, my name is Barry Weber, and I'm a CPA and attorney in the Fresno, California area. And the purpose of this webinar is to bring you up to speed on the new Partnership LLC IRS audit procedures that go into effect in 2018. This is intended for small business activities, and this is only an introduction to the basic concepts and is not intended to be legal advice or form an attorney-client relationship with you. Now, the new rules apply to partnerships or LLCs taxed as a partnership. For the purposes of this webinar, I'm going to refer to both as partnerships, but it also applies to LLCs unless you elect to be taxed as a corporation. Now, under the old audit rules, when a partnership is audited, any deficiency that's assessed is assessed to the individual partners, not to the partnership. And the deficiency assessment applied to the year being audited. So if you were audited in 2016 on your 2014 return, the deficiency that is determined in 2016, if there is one, is charged against the 2014 partners. Additionally, each entity, as it's audited, appoints a tax matters partner, or a TMP, who had the authority to deal with the IRS, but that authority was limited, and a member or a partner could disagree with the result and file a suit. Under the new rules that apply to all tax years beginning after 12/31/17, so they're in effect for now and can be elected for 2015 or 2016 returns, when a partnership is audited, any deficiency that's assessed is assessed at the partnership level, not to the individual partners. And any adjustment that's made is determined in the year of the audit and not to the year being audited. So in our example, if a partnership gets audited on their 2014 tax return in 2016, the deficiency that's determined is now assessed against the partnership directly and is assessed in 2016, not 2014. So you can immediately see that there can be problems if the composition of the partners changes. So the partners in 2016, in our example, would bear the burden of any additional taxes due for the 2014 tax year. In addition, the partnership now appoints a tax partner, or a tax representative or partner representative, who it has full authorities to deal with the IRS. And the partners themselves are bound by whatever agreement is entered into between the partnership representative and the IRS. Additionally, any deficiency in tax that's imposed on the partnership is imposed at the current highest individual tax rate, which for 2018 is 37%. So you can see that this can get very costly, and the IRS will impose that rate unless the partnership can prove that another rate should apply. Each partnership must now appoint a partnership representative and not a TMP, which, as we said previously, has full authority to bind the partnership with the IRS. The PR doesn't even need to be a partner, can be a third party, and if the partnership doesn't appoint a PR, the IRS will appoint somebody to act on their behalf. There are some opt-out rules for small partnerships, and you basically can opt out of the new rules and go back to the old rules if you have 100 or less partners. And there's some other restrictions that are beyond the scope of what we're discussing. Now, if the opt-out is elected, the partners are still liable, and they're liable in the year that under review, and the partnership isn't the liable party. So it's just like it used to be, but you have to elect it. So why do you need to revise your partnership agreements and member operating agreements? Well, number one, you should specify how a PR is appointed, what his authority is, any indemnification of his actions from the partnership, and how do you remove him? There needs to be some consideration for when a partner retires or sells his share, that he provide indemnification to the new partners that could still be subject to a liability that holds over from a prior year. You might even want to consider setting up a tax reserve while the IRS statute of limitations is still open on open partnership years. And the partnership agreement should specify whether or not the partnership elects out of the new tax laws. You also have a situation where prior partners could be asked to cooperate with the PR that are no longer partners, and there should be some provision in the partnership agreement that mandates that partners cooperate with the PR. There could be other agreements that are affected by the new audit rules. For example, loan documents, lenders will most likely desire the partnership to make the opt-out election. Buy and sell agreements need to address pre-closing tax liabilities from open tax years now, where before that wasn't an issue. And also redemption and dissolution agreements should provide for appointing a PR for post-termination audits. So in conclusion, there are some effects that will cause you to have to go back and talk to your legal counsel regarding your operating agreements and like. You can get more information on my website at www.barryweberlaw.com or send me an email. If you want to schedule an introductory consultation or in person or by phone, give me a call. Thank you for listening to this short presentation.